In this video, we are going to discuss about sentiment and asset pricing. Sentiment is known as market or investor sentiment. Behavioral finance literature suggests that sentiment affects trading decisions. Sentiments influence investors' future expectations and brings about the over or underpricing of stocks and thus affecting the pricing models of stock. Behavioral finance claims that irrational behavior of noise traders and arbiters causes a disparity in asset prices for their intrinsic values. Investors may form enormous stochastic beliefs either with excessive optimism or pessimism and therefore incorrectly evaluate asset values, causing asset prices to deviate from their intrinsic value. According to Chang, sentiment is defined as investor opinion, usually influenced by emotions about future cash flows and investment risk. According to Baker and Wagler, it is the propensity to speculate or the optimism or pessimism about a given asset. Now, what could be the cause? According to Baker and Wagler, argued that effect is not uniform across all stocks and is more likely to be associated with certain types of stock, particularly those that are hard to value or to arbitrage. Their results prove that when sentiment is high or low, this type of stock suffer from over or underpricing, which latter reverts. Now the question is, how does sentiment affect prices? Sentiments drive demand and supply, which in turn leads to the price movements. The market sentiment influences the stock markets to be bullish when prices are rising and bearish when prices are falling. Let us understand this with an example. The news, events, and social media comments about a company can be taken in a positive reaction or a negative way by the investors. If the news events and social media comments are positively reacted by the investors, the client sentiment increases, shares are overbought, and the prices of shares fall. If the news events and social media comments are negatively received, the client sentiment decreases and the shares are oversold, leading to price share rise. So, thus leads to bullish when prices are rising and bearish when prices are falling. Is there any approaches for measuring impact of investment sentiment on asset pricing? Yes. There are two important approaches of measuring the sentiment impact on asset pricing. One is the direct method and the other is the indirect method. Coming to the direct method or direct measures, the impact of investment sentiment on asset pricing can be measured by collecting the information through surveys, seeking information from individuals regarding the feelings about the stock market and economic conditions, and electronic sources like internet and social media. Now, the indirect approach or the indirect measures are based on financial and economic variables that depict investors' mindset. According to Simon and Wiggins, every single proxy comes under one of the three categories: performance, liquidity, and financial activities of firms. So the impact of investor sentiment on stock prices can be understood by measuring the performance, liquidity, and financial activities of firms. Brown and Cliff classified indirect sentiment indicators into four categories representing performance of the company, types of trading activities, derivatives trading activity, and market weather vanes. Now, coming to the indicators used to measure market sentiment, there are four indicators used to measure market sentiment. The first one is VIX. The VIX or the fear index is an indicator of a need for insurance in the market during times of increased volatility. The VIX increases as a sign of increased risk. The second indicator is the high low risk. The high low index is a comparison of the numbers of stocks that make a 52-week high as opposed to the number of stocks making 52 weeks low. When the index is high, it is considered to be an indicator of bullish market sentiment and vice versa. The high-low indicator is applied to specific stock market indices such as the S&P 500 and NYSE Composite. The third indicator is bullish percentage index BPI. BPI measures the total number of stocks in a given index that displays bullish patterns over a given period of time. If the BPI is high, around 80% or more, it signifies that market sentiment is optimistic. If the BPI is 20% or lower, market sentiment is considered to be negative. The fourth and the last index, moving averages. The simple moving averages gives the overall price movement of a given security or stock index over a period of time. A 50-day or 200-day simple moving average is a common indicator or a market sentiment. With this, we come to the end of the video. Thank you.